G'day there. Welcome to the week ahead on the 28th of March. I want to start with those US 10 years again this week because we've seen really big moves in the whole yield curve in the US. And I think it's worth just keeping your eye on it and making sure you know what's going on in case equities do take fright if those yields spike much higher. So let's have a look at the charts. So just looking at this US 10-year bond yield chart again, we've been following this quite closely over this last period. And I've been saying to you, when we've watched this range take shape, this is over a whole decade worth of trading in that US 10-year bond yield. We've been keeping an eye on how rates were rising over this last period. And I've been saying once they broke out above 1.8%, that I was thinking it could be a pretty quick trip up towards 2.2%. We've seen that. And when it cracks straight through that level, it's often like a rotation, like you saw here. When rates fell, when we had the false break of the high of that range, around 3% back in 2019, you could see once it started falling, it rotated all the way to the bottom of the range quite quickly. And, you know, it's a similar thing that we're seeing here now as rates rise. Once it's taken off, it's gone through that point of control. It really is on a search for where the buying is going to come in to those bonds. And it hasn't found it yet. So rates have hit 2.47%. So what I'm looking at now as we move forward really is the most recent major wave down from 3% to that lows during the crash. So looking at that buy and sell zone, you know, we are now really heading up towards that area. So that's where I do expect to see some support in those bonds and for those yields to, you know, possibly top out and not carry on higher. So I'd really expect something like that. And it just depends, you know, how high these yields go before they start turning back down. And look, equities are taking it in their stride at the moment. And really, we've got to ask the question, if it does just keep going at this pace, you know, when do equities take fright? And really, above the high of that whole range, around 3.2% in the US 10 years, yeah, above there, who knows what happens? I can't imagine we're going to fly through that area, but stocks will definitely not be rallying if you see those rates really fly higher. I don't really expect that to take shape. The area I've got is around that 2.9, you know, 2.5 to 2.9%, around that area is where I expect those yields to top out in the short term. But you need to see signs of that first. And right now, the selling is accelerating as the 2-year bonds really ratchet higher, with expectations we're going to see 50 basis point hikes at the next 2 meetings. So, you know, those 2 years going from nearly nothing to 2.3% now, that is just an amazing pace of incline. And the fact that stocks are ignoring it is interesting. And I wonder how much longer that can go on for, quite frankly. If we switch over to a weekly chart of the US S&P 500, the main thing to note again is, yes, we've turned up, and I've said last week, you know, we got the weekly buy pivot a couple of weeks ago. So we got the low in the move there, the high of that range there. We got 2 weeks ago a close above the high of that range, giving you the sense of things potentially turning back up. And, you know, that has taken shape, but it is rallying up into resistance. And that, I guess, is the major thing to focus on up close. And this is what I want to point out of how this can develop from here. Because we have the weekly trend down. So we have a rally, which is a short squeeze as far as I'm concerned for the moment, going back to those longer term moving averages. And the thing you want to watch is, does it run out of steam here? From here, for example, if we turn down this week and closed below the low of last week's low, that would be a close below the 10-week exponential. It would also be a weekly sell pivot within that weekly downtrend. That would really change the picture quite quickly. And you could then see things heading down again. And we know the line in the sand we're all concerned about is below that 4,100 level in the S&P 500. Below there, it can look really tragic indeed. So that's the thing I'm concerned about, is that this rally is just a short squeeze. There's selling above. And if we just look at it from the point of view of a little downtrend developing, you can see that where we are now is sort of up in the sell zone of the most recent wave, which would make sense as far as saying that that downtrend could be taking shape. So it is in a bit of a high risk spot where we are opening this week. And the major spot where I'd be wary of getting too bullish would be up in the sell zone of the whole wave down. That's where people are often really fooled that things are going up. And that would be up around that sort of 46.30 to 47.20. So if we did get, another leg higher and then a quick rejection from there, that is another spot where you've really got to be wary. Often amateur traders are, buying up there, thinking we're about to break out to the upside again. But often that's where the major sellers come in. So it's not out of the woods yet. The tendency is to the upside at the moment on this rally, but it's a state where those bonds are really selling off sharply. And I'm just wondering when equities take notice, and we've already got the weekly downtrend in place. So it's just a bit of a dangerous time to be getting overly bullish. And it's actually a good time if you're bearish and you've been holding on to positions on this sort of leg higher to be, maybe lightening the load, especially if you see things starting to turn down again, because the setup is now there that if it does turn down, it can look really bad pretty quickly. So that really is the major thing I wanted to discuss today. Bitcoin is looking a bit more constructive after the work that it's done. You'll notice this big strong rally up to 64,000, the pullback, next wave higher, and I'm making a calculation off that wave, and you'll see we've got the buy zone of that wave down there, and that's where we've been seeing all of this buying pressure over this last period. And it seems to have, found quite a bit of buying pressure there. We got the weekly buy pivot quite a while ago, and then we've been doing a lot of work. And then last week was that, constructive move up through the 20-week moving average, and, showing that there's potential. It could start to kick higher from here, which, potentially is making it look like those waves higher in a trend, isn't it? New wave, back to the buy zone, and then new wave higher. So, that is a potential. But again, the weekly trend is still down. What you don't want to see is a really quick rejection from here and then a failure back below that 10-week moving average on a weekly basis. So a quick rejection and failure after this rally last week would be quite damaging to the overall look. And definitely have a line in the sand now with Bitcoin, under that low around 32,000. It's starting to look quite dangerous, because there will be dominoes. There'll be lots of stop losses under there, and that can set off a chain reaction to go below that major low around 30,000. And yeah, it's pretty dangerous under there. That's when you get targets back down to around 20,000 if it fails. So for now, I think it's looking pretty bullish on Bitcoin. And yeah, you don't want to see it falling over from here. You'd like to see that trend starting to take shape to the upside. So that's it for today. Keep an eye on those bonds. That yield curve, it is getting interesting now. The selling accelerates. I think stocks will take note and take fright. And it is an interesting setup in that S&P that there is definitely some overhead resistance. All right, that's enough for today. I'll come back with more next week. Cheers.